Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, July 18th, 2022. Welcome back to the podcast, Sekido-san.
Good to be back, John.
Good to have you. So let's get right into it. So market speculation for a BOJ policy change, so far this year really built up ahead of the April and June meetings, but the meetings ended up with no policy change as you had forecasted. So we have another policy meeting. We have the July meeting coming up this week. What are your expectations?
Okay. This week, we do not expect the BOJ to make any changes to its framework for JGB purchases. And slowly assess the state of Japan's economy and prices based on the June Tankan survey, the Sakura reports on regional economies, and a corporate goods price index. At the same time, the Monetary Policy Board will likely consider a status report on Japan's financial sector by the Financial System and Bank Examination Department, fiscal year 21 financial sector earnings, and current conditions in the JGB market amidst regular fixed rate JGB buying operations. Market speculation has been fluctuating that the BOJ will make changes to its yield curve control operations now that the upper house elections are over. But in our view, Governor Haruhiko Kuroda is likely to carefully explain the BOJ's policy stance and understanding of current conditions as he did at the April and June meetings. At the same time, we think the BOJ may use incentive interest rates on current deposits for its climate change countermeasure operations and lending support funds as ways to keep Japan's monetary base from shrinking, in line with its overshooting commitments.
Yeah, it's amazing that they need to do that, and while they're also looking to, they're also on offer to, to buy, an unlimited amount of bonds on any particular day, and to kind of take this, to take this to a related subject. So speculation of policy change in Japan has been just all over the place all this year, and it's really been driven by the massive change in tact by the other global, let's call it G10 or G20 central banks. It just doesn't make sense for the Bank of Canada to hike rates 100 basis points while the Bank of Japan leaves rates unchanged and, as I mentioned, just stands at the ready to buy an unlimited amount of bonds. So, that being said, there are some differences. Inflation in Japan is in some ways very different than inflation in other major economies. So let's talk about inflation a little bit. What are your thoughts on inflation in Japan?
Japanese corporate goods price as PPI rose 9.2% year-over-year in June. Export prices rose by 19.1% year-over-year in yen terms, and by 5.9% year-over-year in contract currency terms. Import prices were up 46.3% year-over-year in yen, and by 25.8% year-over-year in contract currency terms. Globally, inflationary pressures are strong on the import side in contract currency terms. And in yen terms, the impact of the weak yen has grown. During my domestic roadshow in June, I noticed an antipathy towards the BOJ's awareness of the yen weakness and negative inflationary pressure. Meanwhile, Japanese exporters have been booking record profits on the back of the yen's recent weakening, with Japanese corporate companies, even outside Tokyo, Nagoya, and Osaka, reported polarization in profit growth. Not only the yen basis, but also the euro yen basis and a pound yen basis has been widening. And even many Japanese exporters are considering converting their surplus dollar euro pound funds back into yen, given the appeal of yen basis premium. Some feel that at the current dollar-yen spot rate levels, investing domestically is more attractive than investing overseas. And a June Tankan survey reflected the trend of Japanese companies repatriating their funds.
Yeah, which makes a ton of sense, but is a very interesting observation. So let's get a little bit more micro here. The BOJ recently released the Sakura report, which surveys branch managers and tells us quite a bit about the Japanese regional economy. Take us through that. Take our listeners through that report and hit some of the highlights.
Okay. Governor Kuroda opened the meeting of BOJ branch managers on July 11th by explaining that he plans to maintain current monetary policy. The June Tankan survey revealed a second straight quarter of deteriorating business sentiment, while the Sakura report raised the economic assessments of 7 of 9 regions of Japan, all except for the Kanto Koshin region near Tokyo and Tokai region near Nagoya. According to branch managers in the Sakura report, even with companies and households sensing that the economy is recovering toward a post-COVID state, several trends stood out. First, the difficulty of implementing a price pass-through to retail prices because of Japan's strong consumer purchase power, fundamentally based on an aging society. Second, companies managing high resource prices with capex. And third, the strength of supply restrictions for production and exports. As far as my meetings with companies in June go, I get a sense that the majority of Japanese companies are revising their fiscal year 22 financial strategies. In June, Governor Kuroda commented on the importance of changes in retail consumers' buying behavior and corporate price-setting activity, leading to higher wages, maintaining a favorable macroeconomy, and leading to wage hikes beyond fiscal year 23. Although the June Tankan and Sakura report shows negative effects in the economy's corporate and household sectors, Governor Kuroda appears to believe positive effects of yen weakening to the economy.
Yeah, plenty of negative externalities there. Earlier, I think you said that import prices were up over 46% year over year, which is just absolutely insane. But yet consumer inflation remains somewhere around 2%, which is mind-boggling. Plenty to unpack there. But let's do this. Let's leave things with your outlook across yen rate, spot dollar yen, and yen basis.
U.S. jobs results reflecting the tightness of the U.S. labor market and entrench the inflationary pressures, as shown by this CPI data, both support a strong dollar hedging. Euro-dollar hits parity. The market is pricing a 75 basis point rate hike by the FOMC in July. The BOJ and ECB both meet this week, with the ECB expected to hike interest rates by 25 basis points, and the BOJ to maintain monetary easing. The yen will likely continue to weaken. We now see the dollar yen trading in a 3 yen range between 136.50 to 139.50 with a bullish bias. While the yen swap rate curve is rising and a yen bond yield curve has been neutral, the upper house elections and a 5-year and a 20-year JGB auctions are now over, and there is concern about upward pressure on the yields from outside ahead of the BOJ's Monetary Policy Board meeting on July 20th to 21st. central banks around the world hikes interest rates. However, foreigners have been net buyer of medium to long-term yen bonds for the past 3 weeks, net buying 5.5 trillion yen of yen bonds the last week alone. And the popularity of the yen bonds among the G10 bonds has stood out. We expect the foreigners to show an even bigger presence in next week's TDD auctions, 1 year on July 19th and 6 months on July 20th. We expect the yen rates to return to neutral. The yen basis curve has widened somewhat. Ministry of Finance data for July 3rd to 9th shows that the Japanese investors unloaded a net 548 billion yen of foreign bonds, including a net 1.4 trillion yen of medium to long-term foreign bonds, while net buying 254 billion yen of short-term foreign bonds. They net bought 687 billion yen of foreign stocks and investment fund holdings. Japanese investors have unloaded foreign medium to long-term bonds for 7 straight weeks, with foreign stocks and alternative investment via investment funds steadily becoming the main driver of external securities investing for Japanese investors. Over the same week, foreigners net bought a sizable 6.1 trillion yen of Japanese securities, including a net 3.5 trillion yen of short-term yen bonds, 2 trillion yen of medium to long-term yen bonds, and 526 billion yen of Japan stocks and investment fund holdings. Overseas investors have been returning to JGBs at a faster pace, with Japanese investors continuing to unload foreign bonds and reshuffle their holdings with alternative investments. Foreigners are unlikely to show less interest in JGBs. We expect yen basis to return to neutral bias from a widening.
That's interesting. Okay, so bullish on dollar yen, neutral on yen rate as the BOJ defends or continues to defend the upper band of its yield curve control policy, and also neutral on basis. But you did mention, earlier in the podcast, that Japanese corporates and then more recently that foreigners are there's definitely some demand from basis from both those investor and or corporate community. So perhaps something to watch. Great stuff as always, Sekido-san. Thanks for coming on the podcast.
Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.